What's up, everyone? It's Scotty with MoneyVest. I messed up, and the reason I messed up is because I set the time. I thought I set the time to be 9:30 p.m. Dubai, but it actually was 8:30 p.m. Dubai. So I do apologize. And I was in the meantime working on a VIX spreadsheet, a cheat sheet for all of you, Volatility. So again, I'm live now. We're going to be live for quite some time for the next 2 hours until the end of the press conference. So it's going to definitely be a longer live stream. So thank you so much for joining. I really appreciate it. Only thing I'm asking in return is that you drop a like on this live stream. We really want to get up to over 400 or 500 likes so that it gets pushed out by the algorithm to other and more viewers who want to join. So no, I wasn't sleeping. So a lot of you guys are talking about how I was asleep. I was not really sleeping. I was just really, like I said, I messed up on the time because I was trying to figure out, because there's also daylight savings this weekend. And for some reason, I thought I put in 9:30 p.m. Dubai, but it was actually 8:30 p.m. And in the meantime, I was kind of working on the volatility spreadsheet and I just completely lost track of time. And but nonetheless, here now, we're going to run through the entire analysis for Jerome Powell, for the Fed. So we've got lots to discuss. And of course, we will take a look at the market's reaction for when the statement comes out in under 41 minutes now. And then we'll take a look at the press conference and listen to what Jerome Powell has to say to address the market and what the guidance is going to be like. So thank you so much for joining. Again, I really appreciate you guys for spending the time over the next couple hours. It is going to be a pretty longer live stream, like I said. And SPY here is up close to 48 basis points. We got the QQQs up over 84 basis points and the Dow Jones up over 22 basis points, with the yields dropping a little bit over 2.3% right now. So they're definitely starting to see some weakness brewing back down to just a little bit over 4.8%, with TLT and TMF obviously seeing a very nice move back higher, with TLT up 1.2%, TMF is up a little bit over 4% as well. So once again, thank you so much. Okay, so we saw the VIX message, but no Caddy in the live stream, so we figured that maybe you were quickly went to buy Neuralix to celebrate the Fed meeting. No, so thanks for the VIX. Looks cool, bro. So yes, Milan, I wanted to basically go over what that spreadsheet is going to tell us. So again, if you want to get access, link is going to be down below. I just shared this with all the members, and there's also going to be the intrinsic value and fair value spreadsheet coming out this week. We're kind of making everything look super clean, super concise. It's going to be very, very useful data, very useful information. Because we're doing a lot of analysis and a lot of research, kind of back testing a lot of these things to better understand, okay, what's going to help us, what's going to be useful for both trading and investing purposes, right? So those are the type of analysis that you can see now moving forward, a very, very data-driven macro analysis, as well as individual stocks, and not to mention volatility and yields and interest rates, all that stuff. So again, if you want to access that, link's going to be down below. Let me see if I can pull that up. I believe I had a screenshot for it. So there we go. So this is the type of analysis I just shared, the MoneyVest VIX cheat sheet. What this basically shows us is the different percentiles for the volatility. And right now, the VIX reading, by the way, it shows you the current read over here. This is going to update automatically every single day. So if you do reload, this web page, it's going to tell you the current read, and it's going to tell you the percentile that we're in, and whether I call this the VIX rareometer, whether this is normal or this is rare. Because if it's rare, that's usually the time to be making decisions, right? In the market, you want to be looking to buy or sell, depending on the conditions. Of course, the higher we are, the better it is to be a buyer in that market, and the lower we are, better it is to be hedging on the downside, because the markets can start pulling back because volatility is low. And if it spikes, that's usually the time when you want to be hedging your position. So it's going to be incredibly useful. Again, like I said, we're going back, significant amount of years. I think we went back as far as 1999 for the QQQ analysis. So it tells you the correlation between the NASDAQ as well. So negative 0.61 or negative 62%. And this also will tell you all these different observations. So 8,500 observations, right? So if you go back 8514 divided by 252. So yeah, 33 years worth of data is for this analysis for volatility. And this right here is the implied volatility for the S&P 500 on a 1 year, 1 month, 1 week, and 1 day basis. All these percentages calculated for you and available in this nice spreadsheet. So link's going to be down below again if you are interested. And I'm happy to go over that in more detail if anybody doesn't understand like what exactly this represents, because what we're trying to do is we're trying to get the signal from the noise, right? That's the whole idea, is that we don't want to, look at too many data points, too many variables, and at the end of the day, not really make a decision. But it's really kind of looking at the most important data and looking for the signal among all the noise, basically. So that's what this number basically is going to do at the top. So it's going to tell you the current read, the percentile we're in, the rareometer, which is going to be either normal or rare. And then, of course, the correlation is going to be staying the same. It's going to change a little bit every day depending on the new values that are being coming in for volatility and for the NASDAQ. So that's going to be it. Let's just start our poll. What should we do the poll on today? We've got, again, I think 98% probability that the Federal Reserve is going to keep rates steady. So by the way, 36 minutes now before the statement comes out, and 98.8%, so just under 99% probability that the Federal Reserve is going to keep rates steady. So I don't think that needs a poll. I think what is going to be interesting is what is Powell going to say, right? So Powell... today, let's just put down hawkish, dovish, or neutral as a poll for today. And everyone, I really want you to drop a like on this live stream so we can have more and more people join. And of course, the algorithm to do its thing. I would really appreciate that. And also do participate in the poll that I just created. Okay, so going over to the last reading on the statement. So we obviously know that the Federal Reserve kept interest rates steady at 5.25% and 5.5%. So that's really where we are. And they continue to, roll over their balance sheet in the tune of $60 billion per month for treasuries and $35 billion per month for mortgage-backed securities. So this is just under $100 billion of that path, or basically that calendar right now each month that they are rolling over from their timeline. In other words, they did buy significant amount of treasuries and mortgage-backed securities over the last couple months, and now they are essentially lowering that in terms of their balance sheet, and that has obviously come down over the last several months here. This right here is going to be the summary of economic projections. Now, this meeting, we're not going to get an SEP. The SEP comes out in the December meeting. So if you come down, this right here were the forecast from the Federal Reserve, which they updated, of course, in their previous report, which was in October. So this was released in towards the early October, September 20th is when they released this. So one of the biggest reasons for the markets dropping in September was once again one of the most brutal months in 2023 as well, is because we specifically talked about rate cuts, right? Rate cuts being priced in 2024. So what you'll notice is that June projections were rates going down from 5.6 to 4.6%. So that was full 100 basis point cut. In other words, 4 25 basis point cuts that the Federal Reserve was pricing in. They changed that to only 50 basis points now. So 5.6 to 5.1, right? So they are now expecting a higher terminal rate in 2024. In other words, they're expecting fewer cuts in 2024. And that was probably one of the biggest reasons why the markets did sell off the way they did, is because we were expecting two bearish outcomes. Number one, either the Federal Reserve pencils in higher rate hikes, in other words, more rate hikes in 2023, or they pencil in fewer rate cuts in 2024. So it was either more rate hikes or fewer rate cuts. Either of those things would have been bearish, and we got the latter, which was fewer rate cuts in 2024. And as a result, the markets obviously did sell off, and that was a negative reaction to what the expectations were versus what the Federal Reserve is telling us. Now, there is still a discrepancy. So if you come back over to this right here, the Fed probabilities, and you'll notice that right now, the market's, looking at pause all the way through 2023. So end of 2023, we're not going to see any more hikes. In fact, 15 banks right now expect the Federal Reserve to hold rates where they are and not raise any more. And they're expecting 3 cuts in 2024, whereas the Federal Reserve's told us 2, right? So 2 25 basis points. In other words, total 50 basis point cuts from 5.6 down to 5.1%. So that's where we are. There's still discrepancies between what the market's expecting versus what the Federal Reserve's told us. So it's either the market eventually reprices, readjusts to the Federal Reserve, or the Federal Reserve eventually comes in line with what the market's expectations are. Eventually, they both have to be aligned, and right now we're not. But that discrepancy has narrowed. Earlier, it was pretty significant. Now we've come down to maybe 2 discrepancies, which is 1 less rate hike in 2023 and 1 additional rate cut in 2024. is what the market's pricing in versus what the Federal Reserve's told us. So that's where we are. And, going into this meeting, of course, all eyes and ears are going to be trying to interpret what is the Fed saying, what is Jerome Powell saying for 2024. Next year is really what's going to matter now at this point, because I do strongly believe that a lot of the damage is now starting to happen from an economic standpoint. We were having this discussion in our Discord as well, and I think Paycom's earnings do tell us a little bit more into how payroll activity, unemployment, that's starting to struggle just a little bit. Joel's numbers once again increasing, so job openings continue to go up, and then ADP numbers came in way below consensus. Jobless claims are coming out tomorrow, so that is one of the most important leading indicators for unemployment, because if I show you the initial claims, so this right here is going to be the initial claims, and if we simply put together, right, the unemployment rate, so that's going to be the UN rate, that's the unemployment rate, and we put that in, let's say, a new price scale here, you'll notice that the initial claims actually do start going up a few months before the unemployment starts going up. So you can see the blue line, right? So that's the blue line, as you can see that it's actually starting to move up faster or before precedes the unemployment rate actually spiking. This right here, again, you can see a little bit of that increase happening prior to unemployment starting to go up here. This right here is, once again, you can see the unemployment rate. This is the jobless claims, which are starting to move up, and then eventually unemployment rate follows. Moving forward here, so this is a perfect example in 2000s where you can see the blue line going up before the orange line takes over right over here. That's the unemployment rate. So tomorrow, and this is actually quite consistent. In 2007, 2008, they're both moving up at the same time. And this also very consistent in 2020, 2019, but that they both go up at the same time. But in the past, they have preceded by a few months. So unemployment claims, initial claims, jobless claims, very, very important numbers every Thursday. And they haven't been able to break past that threshold of 300, 400,000. And for that reason, I'm not concerned just yet, because we're still, at 210,000 right now. So if you basically just zoom in a little bit, we were at 265,000 in June, and we've just been slowly and steadily going down. And we haven't crossed over 300,000. We haven't even crossed over 265,000 since October of 21. And that was on the way down, right? So there's going to be a couple thresholds to definitely watch. Of course, there's going to be 300,000 right over here. And then, of course, we're watching all the way up to as much as 355, 357, to as much as 430, 440. So if unemployment claims actually do spike, 50%, 100% to those levels, that is going to be pretty concerning from an unemployment standpoint, which eventually will lead to higher levels as well. Unemployed persons will catch up, and unemployment rate will also start pushing higher. So that's something to keep in mind. And of course, the Federal Reserve is going to be watching these numbers very closely as well. And that's really what's going to determine whether interest rates stay higher for longer, or they do get cut, or if there are going to be any more rate hikes. All right, so people talking about end phase. So if you have any questions, let me know, and I'm happy to go over some of the more macro stuff, because this is really, comes under macroeconomics. This is in the speech at 2:30 p.m. Eastern. So more than 1.5 hours from now. Yes, speech is in at 2:30 p.m. Eastern. So we are definitely early right now. So 9:30 p.m. here. So that's about 1:30 p.m. over in New York. So in about 1 hour now. In 1 hour, we'll have the meeting. And in 30 minutes, we'll get the report. Keck says the last couple of meetings, Powell speaks and the market sell off because of how he words his speeches, which leads to algorithmic trading to selling off as well. Yeah, whatever Jerome Powell says, it's super vague, and it's oftentimes repetitive, right? Things that we have already heard from Jay Powell in the past. So I don't expect anything to be like new information, other than the Q&A session, which again, I think reporters are going to try to press on the idea of, have we reached the terminal rate, which I believe Jerome Powell is once again going to say that, we're going to leave the door open. I think that's what's going to be the key takeaway from 2023 standpoint, is that we're going to leave the door open to potentially raising interest rates further. So we can't guarantee that the rate hikes are they're complete. But again, we're going to be very, very data driven, right? So it's things that we have already heard from Jay Powell in the past, but the market's still going to be interpreting it in many different ways. PayPal 5% up or 5% down. So again, it depends very much on earnings, right? So earnings are coming out later today after the bell. Pre-market right now, well, before the market's closed, you're down about 1% at the moment. So just a little bit over $51 at the moment. So not a lot of movement here. And if you take a look at individual stocks, so Apple, for example, is slightly higher, 82 basis points. We've got Tesla here pushing down slightly, just flat. Microsoft's up over 1.6, and Nvidia also pushing up over 2%, with AMD having quite the day, right? Up over 8% on the day here. So very, very strong momentum and rally back to the upside. So again, if you have any questions about the economy, about macroeconomics more specifically, because that's going to be the theme for today's live stream, Jerome Powell, again, is going to be speaking less than an hour. So let me know. I'd love to go over and have that discussion, because that's the beauty of, our having a community, is that being able to talk about these certain things: unemployment, labor market, inflation, interest rates, so that we get better understanding, better clarity on what's really going on in the economy, right? Especially the largest economy in the world. So Ian Holmes, thank you so much for joining, man. Hope you're okay. How's life in Dubai? It's great. It's phenomenal. I love it here, and I'm trying to encourage as many people to move here as possible. But of course, it's been amazing. I love it, so I can't complain. Everything's fast, everything's efficient, and things are going well. Knock on wood. All right, charge point, please. It's still beaten down. Where do we buy? So again, I want to keep this more towards macroeconomics, because, like I said, we can analyze stocks a lot during our other live streams, but since the main focus is going to be on Jay Powell and interest rates and inflation, I would much rather prefer some macro questions, but I'm happy to go over some stocks if we have time. So, wow, charge point really getting crushed here. I haven't looked at this stock in such a long time, but incredibly oversold. I think business fundamentals are still not great. I think it's got a very similar business model, not really business model, but like the trajectory that we've seen for ChargePoint has been very similar to, unfortunately, NEO as well. And that's what it comes down to at the end of the day. Like, profitability is so important for any business, right? In order for it to be sustainable, in order for it to be viable long term, it needs to be profitable, right? Execution is the main key for any business. Okay. So if you are looking at a company that's not profitable, that's not generating positive cash flows, the quality of that company is not that great, but you still believe that, okay, it's got a lot of potential, right? Because at the end of the day, potential is intangible. You can't see it until it's actually realized. So I would personally start with a very small position, and as your confidence builds into that company, you can always add more. But with companies like ChargePoint, NEO, with companies like, Fiverr, for example, or Upstart, like companies that haven't really validated that business model yet or aren't profitable, there's high risk, high reward, right? Yes, I mean, ChargePoint could, potentially 10x or 20x over the next 20 years or whatever, but it's also carrying a significant amount of risk because it's not profitable. It's not self-sustaining business just yet. So, that's the give and take. That's the thing that you have to ask yourself, is how confident you are in that business. What's your conviction level? And if it's really high and the company's still not profitable, I would personally be going in with a very small position, then averaging into it as the confidence builds over time. What's my take on Amgen? So let's take a look. Amgen is actually a phenomenal company. It's pretty good, but we did have a little bit of a double top here and overbought RSI, overbought MACD. We're starting to see a bit of a pullback on the weekly time frame, and got a nice higher low sitting right over there. So if it does end up, selling off down to 224, 225, would represent as a good trading opportunity for Amgen. If you take a look at some moving averages, oh, perfect. That's exactly where the 200 SMA is also going to be. So 200 SMA is sitting at 225. And in the past, you'll notice that it's perfectly validated that support. So that 200 SMA, boom, right here, nice support, nice support, nice support. And this is what an uptrending pattern looks like. This is literally what buy the dip looks like. I mean, if I Google buy the dip, I should get Amgen's picture. The chart picture should show up, because this is really what an uptrend, higher high, higher low looks like. And as soon as it hits that 200 SMA on the weekly, it gets bought up very, very nicely. Now, the only difference, okay, what is so why is the probability for us to retest this 200 SMA and then break down below this level a little bit higher than in the past? Let me see who can answer this question. This is going to be a technical analysis question, but why is the probability slightly higher this time, the moment it gets down to that 200 SMA, for us to break down a little bit more than in the past? I want to see if anybody can answer this. Let's see. Let's see. I'm going to go over some other stocks as well. Walt, I'll get to your question here in just a minute. But definitely do try to take a stab at this question. And this is the higher high, higher low pattern for Amgen. But the question is, why is the probability for us to see a potential breakdown below the 200 SMA this time higher? Okay, so Urban says double top. Yeah, so that's a good catch, right? Double top. And every single time you'll notice that once we did bounce back higher, we actually ended up making a higher high, right? So that means the strength of the pattern is still there. We were still making higher highs overall, and the pattern was going higher than it did the previous time after bouncing from its 200 SMA. But this time you'll notice that it actually did not make a higher high. It got rejected at the same price and made a little bit of a double top. So that means, okay, buyers are not strong enough and sellers kind of came in at 289, 290 to bring us back lower. So yes, the risk reward is going to be actually very attractive here at 225, but the probability is going to be slightly lower than the past, where it's perfectly worked out bouncing off of that 200 SMA. So good job. Not a lower high, but a horizontal high, right? So in other words, a double top. Yes, so didn't make a higher high. Absolutely, you guys are right. Marcus says there wasn't a higher high. John says didn't make a higher high. Perfect. And you guys are on top of it. I love it. Okay, so let me rephrase the question. Do you think, Caddy, that today's Fed meeting and JP speech is going to be impactful on the future of rates and economic outlook and so will influence end phase? Yes, I think whatever the policy guidance ends up being from the Federal Reserve, from Jay Powell, is going to most likely affect innovation and tech stocks more than some of the other companies out there. If you look at defensive, and here's what's interesting, right? If you take a look at how the markets have performed and where the liquidity is kind of shifted to over the last 1 month. So this is the heat map. And if you just look at the last 1 month, right, you'll notice that the utility sector is actually doing better, right? Utilities, so groups is where we want to come to. And look at this, the last 1 month alone, right? This is just the last 30 days performance, 1 month. Utilities is actually a 4.5%, right? And they are actually one of the best performing they are the best performing sector next to all the other 10 to 11 sectors. Healthcare, comm services, right? Even energy, materials, financials, everything has seen liquidity go out, and utilities has gained substantially more. Utilities usually tend to be the most defensive sector of them all because in a recessionary environment, people will give up everything, right? They won't buy a car, they won't buy a phone, they won't take that vacation. But the only thing that they can give up on, give up spending money on, is utilities. They still need electricity, they still need water, they still need trash and whatnot taken care of, right? So, for example, waste management is actually hitting almost all-time highs again. This week, it's up over 1.6%, 2 consecutive weeks in a row. And since the market has underperformed in July, since July basically, waste management is on its way back up. So if you do waste management divided by SPY, you'll notice the significant outperformance that's been happening for this company in the last couple of weeks. This is the weekly chart, by the way. So we're going back as far as September. So utility company is definitely seeing a lot of momentum. XLU pushing higher, from that support. So if you take a look at XLU divided by SPY, it's also been selling off quite a bit since January of 23, but since October, since last month, of course, it's seen a lot of outperformance in the last 1 month. In terms of the multiples, that's also what I want to go over. So forward price earnings multiples. I mean, tech, clearly seems to be expensive, right? Tesla 51, we got Amazon 38, Apple 26. I think it's closer to 27, 28. Microsoft 26, Nvidia 24, which is actually not that crazy if you really think about the growth potential for Nvidia. AMD's at 28. We got Google and Meta still trading at a very, very good price to earnings multiple. But then, Costco 32, Eli Lilly 43. Visa, MasterCard, really low. PayPal's 9. Oh, poor PayPal. 9 forward earnings. Absolutely crazy. Jeff says, I've been looking to possibly pick up a property in Dubai too. Love that place. Yeah, I mean, prices are just crazy high here. I mean, just in the last 1 year, we've seen a 40%, 50% increase in prices here. So I am definitely holding off on buying anything because it's insanity how much prices have increased. Let's see. Urban, in the case of double top, would you consider purchasing at one of its previous bottoms? How far back would you look at the price in personally? So, I mean, really, it's going to be that 200 SMA to really look at when Amgen, if and when it actually trades down to that support of 225, it's going to represent a pretty good, low risk, high reward potential opportunity. And that's what we're looking for in the market, right? We're looking for asymmetric risk reward opportunities where we're not risking as much and reward potential is pretty considerable. And that's the risk reward ratio that we have to analyze. Will Powell a nice tone because of the conflict in the Middle East? Keg, I don't know can you rephrase that question? I don't understand what you're referring to here. Monos, it was almost easy to go down from 93.7% as it has to do with inflation, but it is difficult to go from 3.5 to 2% without any further restriction in policy. Yes, the marginal benefit that I think we'll see. Now, let me just put it this way. The rate hikes, right? The amount of rate hikes that we're seeing now, or if the Federal Reserve does 25 basis points from now going forward, the marginal benefit on inflation is going to be lower than the marginal pain that we see in the economy. Because now, at over 5% interest rates in the US and mortgage rates at over 8%, credit card debt over $1 trillion, with auto loans also hitting highs of double digits now, used cars and new car vehicles, the amount of pain that the US economy is vulnerable to with rates so high as they are is significantly more than the benefit that we may see of inflation coming down with higher interest rates. And I think that's why there's a lot of folks in the media also very vocal about the Federal Reserve needs to cut rates, right? Jeremy Siegel, Kathy Wood, I mean, they've been vocal about deflation risk more than inflation risk. And they've been saying, and even Bill Ackman, recently came out and said that the economy is slowing faster than the data suggest. So I think 2024 is going to be quite an interesting year. And if we actually do end up in an economic recession, which is going to be, reported by the NBER, the National Bureau of Economic Research. I mean, they're the ones that actually do announce whether we're in a recession or not. And they do it few months after, like months after we've already been in one. If the market do end up pulling back, I think that's only going to represent a significant amount of opportunity for us. And we also have to be accounting for the volatility and where it ends up going, right? So, of course, the current reads at about 17.6. If it gets up to over, 40, 47, 76, I mean, those are just incredibly high levels. And that's the reason why this is in green is because that's a big signal for me to go into the market a bit more aggressively and start deploying cash, because at the end of the day, we're really looking for deals, and markets coming down are going to create a lot of deals, a lot of opportunities. Okay. So, Jetto, one last Dubai question, please. I would love to know what was the catch of you choosing to relocate there. I actually did a video on our Patreon going over the entire reasoning and the story, so you can check that out. I go over that in more detail. I had an option to basically move between Canada and the UK and Dubai. So the Dubai actually ended up being very, very spontaneous at the end, because I was supposed to come here on vacation and I haven't left. And then I just basically converted everything from tourist to resident. But yeah, I did a video on this on our Patreon. You can check that out if you want to. It's super insightful. It's going to answer all the questions that you possibly can have on Dubai. So waiting to get into PayPal. Let's hope their earnings are good. If they are, do you think it would be a good time? Yeah, so I actually did a calculation on PayPal, and even if they grow their free cash flows by only 5%, right? That's the crazy part. That's how much oversold and low valuation it's trading at. Is even if they grow their free cash flows by 5%, and we discount the future cash flows by 12% back to present value, PayPal's at intrinsic value right now, $51. Now, if they can grow the free cash flows from 5 to 10%, then the intrinsic value is at closer to $70, right? So 69. So in other words, it would be considered undervalued if we believe that PayPal can grow its free cash flows by 10%. And that's what's the crazy part, right? I mean, market has completely disregarded this company and has just thought or believed that this company is done for. So if today's earnings are good, they reiterate guidance, and they have a plan in place for 2024 and beyond, then I think that's going to restore some confidence in PayPal. But if they still sound uncertain about the future, if Alex Chris doesn't do a good job in kind of explaining the vision to the investors and to Wall Street, and basically, the numbers not being as great as what people are expecting, this is really just the make it or break it moment for PayPal. It's already trading at a 7-year low, and if the numbers aren't great, if they miss on EPS or revenue, if they miss on guidance, I wouldn't be surprised if it breaks below $50 and just whoever the last people that are holding on to will capitulate at that point. Whoever is holding on to PayPal right now will capitulate, because this is about as extreme as it gets. It's dropped from... Now look, the markets overshoot every single time, right? They overshoot on the upside, they overshoot on the downside. There's dislocations every single time. Very rarely you'll find a stock, go up in a linear fashion, right? So when we talk about compounded annual growth rates, and there's actually an interesting comment in one of my videos where we were discounting future cash flows back at a 12% rate, but we were also growing those cash flows at a 27% rate, 28%. And then we chose a terminal rate of about 3%. And the person in the comments was like, in what world does a company grow at 27% and then hits a wall after year 5 and starts growing at 3%? Well, the reason for that is because we never see 27% exact every single year, right? 27% is the compounded annual growth rate, right, over 5-year period. So year 1 could be 40, year 2 could be 30, year 3 could be 27, year 4 could be 20, and year 5 could be 15, right? And when you average those out on a compounded basis, that's the rate, 27%, that we're looking for. It's not 27, 27, 27, 27. It's not every single year. It's higher and it's lower, and then it averages out to that rate of return. And it's the same thing with valuations too. Now valuations become very, very extreme on both ends, right? They inflate and then they basically get sold off to extreme levels. Now, at these prices for any stock, it becomes more of a question of whether this is an actual dislocation with the price versus the value, or this is a value trap, right? That's the analysis that we're really doing, is PayPal a value trap now where the market is correct in pricing it at $51 and I'm wrong in buying this stock at 51, or if this is actual dislocation where the price is not corresponding with the value as well. In other words, the value is way high up there and price is still way below its intrinsic value. So, and that's where it becomes very, very interesting, because in investing, you can have all the intelligence in the world, but if you don't have the stomach to hold the stock through these downturns, it becomes difficult from a long-term perspective, right? So you definitely have to have a strong stomach. That's what Peter Lynch said, right? So Nima, for end phase, I've already mentioned the main cue that I'm waiting for is interest rates. That's really what it's going to come down to, because higher rates are definitely hurting end phase right now with their demand. And CEO Badri specifically mentioned this in their earnings call. Let me just pull that up. End phase earnings call transcript. So if you go over to specifically search. So this right here is what they mentioned, right? So we expect to make this software release as part of our standard offering to any country that we enter. Let me conclude, we are managing through a slowdown in our overall demand. In the US, it is due to higher interest rates. So, interest rates are definitely going to be a big factor in Enphase's future performance. And Enphase has struggled so much because we're seeing rates as high as they are in over 16 years. The US 10-year treasuries haven't hit these levels since 2007. So in 2018, we were at 3.3%, but at 4.8 at close to 5%. We haven't seen these levels in 2007. So Enphase most certainly is dealing with significant amount of pressure at the moment. Actually, let me just see very quickly. So if you just pull up Enphase here, and if you just plug in the federal funds rate, it's actually quite interesting, isn't it? The orange line is the Fed funds rate, right? Which is what the Federal Reserve's interest rates is what they control. And the markets are forward looking, right? So stock prices do get do move a lot faster than economic policy. So I'm sure there were more reasons in 2015, 2017 when the price was selling off like this. And Enphase was down from its highs of $15. It actually sold off 95%, 95% sell off here. And at the same time, I mean, rates were on their way up. But then, of course, when rates started getting cut over here, the price was already on its way back higher because, like I said, markets are forward looking. And we have seen since here, the rates gone up as crazy as they have, and the price has just been selling off. So there's a good sort of inverse correlation between the interest rates from the Fed and the price of Enphase stock, because then at the end of the day, net income gets affected, demand gets affected, and then the price ends up looking like this. 3 straight week-to-week red candles. All right, so let's see. All right, we got the numbers coming out, statement coming out in about 7 minutes now. So 7 to 8 minutes is when the statement from Powell is going to be released from the Fed, basically. The entire fintech sector is down substantially. That's true. And Ian, thank you so much for reminding everyone. Everyone, make sure that you drop a like. I would really appreciate it. Right now we're at 113. We're hoping to at least get up to 400. We got 400 people watching and 100 likes. That's like 25% of you guys. 1 in 4 people is liking at the moment. I will answer every single question if every single one of you likes. If you like, I will answer your question. Marcus says that's $35 soon, overvalued. I mean, I guess there's some truth to that, considering if the valuation does compress, and I mentioned this in one of the videos, that this is the biggest risk for Tesla and other growth stocks, is the valuation, right? Multiple compression is very brutal risk. It happens fast. It happens overnight. Something that you were seeing with Paycom today, right? This company is down 38%. Why? They reported good numbers because the growth is slowing down. Okay, on an absolute basis, they reported 10 to 11% growth in 2024. Wall Street was modeling in for 21%. So if you look at it on an absolute basis, 10% growth is still good, right? If the company is able to grow 10%, 11%, that's still pretty good. But that is lower than what Wall Street was expecting at 21%. So what's getting readjusted here? The price to earnings multiple. It's compressing down because it was trading at over 32, 45 times earnings. And now most likely a third of that is gone. 38% is a pretty significant sell-off, and it's going to be most likely more appropriately priced now. But even then, sub $100 is really what I'm watching for. Did a video on Paycom earlier today. So, a lot of these growth stocks and tech companies, they do carry a lot of multiple compression risk. Same thing happened with, Meta. Same thing happened with Nvidia. Same thing happened with Upstart. Same thing happened with Enphase. Is happening with Enphase and PayPal and a lot of these companies as well. Okay, love to hear your thoughts on URY. It's a high conviction macro infrastructure play for me, low PEG ratio and good margins too. So let's take a look. I'm going to go over stocks from Frank because he does come out with some very, very good underrated companies. So we got good revenue growth, good profitability, margin expansion as well, so 18%. And if you take a look at the future, we're looking at $40 all the way to as much as $51, and revenue also expected to grow, with a valuation at just under 12, 2 times sales, 6 times cash flow, and a little bit over 3 times book value. Let's see. We got $12.6 billion of net debt, so we're assuming more debt than cash, just a little bit under $3 billion of current assets. Of that, $2.2 billion in receivables and $284 million in cash. Let's take a look at liabilities here. Total debt sitting at just about $12.9 billion. So, I mean, it's an infrastructure company, right? So it is a company that operates through general rentals, specialty segments, so construction, aerial, industrial equipment. So you'd assume the margins are not like super high for this company. I mean, it's not like a software company, but still 18% profit margin is actually pretty good. But the balance sheet is, I would say, just a little bit of a concern. I mean, I understand the business that it operates in doesn't allow you to have a pretty significant amount of cash versus debt. So I guess it's manageable. And then cash flows, we're looking at, I guess, consistent growth, 614 million grown to 743 actually. So trailing 12 months definitely struggling a little bit. And we've got share count going down. So that's exactly what we want to see, the number of shares going down for the company. So I would say I like it from a valuation perspective, like it from a reasonable growth and value perspective, and dividends 1.4%. So that's okay. Balance sheet is the only thing that I would look into a little bit more, because the company does have a lot of receivables as well, right? So we do have over almost $3 billion of receivables, 2.2 billion. Inventories 201 million. Yeah, no long-term assets, and we got net property, plant, equipment 16 billion, and goodwill is 5.7 billion. So 5.7 billion off of 25, that's about 20% of their assets are in goodwill, which is intangibles. You can't see or touch goodwill, right? My threshold is like less than 10% of total assets kind of making up the goodwill. Anyway, we will get caught up in these conversations, guys. We have to focus. The numbers, the statements coming out in now 2 minutes. So 2 minutes is when the statement's going to be released. There we go. That's the press conference. All right, we're going to go to Federal Reserve. Everyone, make sure that you drop a like, or I'm going to withhold the numbers. We're not going to go over it if you don't like the video. So definitely do drop a like. Hopefully we can get up to at least 200 before the numbers come out in less than 2 minutes. Caddy bond auctions are today, $766 billion in sales. How will this affect the market? I mean, we already know, right? This is going to not be great because a lot of debt issuance, a lot of treasury issuance leads to more supply hitting the market. If the demand is not as strong, that leads to higher yields. However, yields are still dropping on the day today. So we're seeing a little bit of that pullback. I do think there is some negative divergence forming in yields, which I was also kind of marking out the other day. And you can see the higher high in yields and the lower high on the RSI. And something very similar happened here. This was back in October. Higher high in the yields, lower high on the RSI, so a little bit of that negative divergence. Then eventually we did obviously drop over 18-19% for yields. So, and the reason why this is so important is because we didn't really see that negative divergence up until more recently. The yields continued to push higher, and so did the RSI. It was very strong with the breadth behind that move higher, and it was basically flat, right? So horizontal highs up until October 2023 when it hit a high. RSI went up to 79, close to 80, and then it started to roll over. Anyway, so let's just go back over to the markets. QQQs is going to be on the right, SPY on the left. We got the Dow Jones over here, and we are ready to rock. I'm going to reload this page, and October 31st. Let's see. It is 2 p.m. now. There we go. Now we've got the PDF. Let's click on it. And 5.25% and 5.5%, folks. So we are steady on the rates. No rate hikes in October-November meeting. So that's exactly where we are. But let's just quickly read through this. So recent indicators suggest that economic activity expanded at a strong pace in the third quarter. Job gains have moderated since earlier in the year, but remain strong, and the unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Word for word, it's like they don't even have to do any work. They can just print last month's report and just paste it into the new one. Tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. And the committee seeks to achieve maximum employment and inflation at a rate of 2% over the longer run. In support of these goals, the committee decided to maintain the target range of the federal funds rate at 5.25% and 5.5%. The committee will continue to assess additional information and its implications for monetary policy, and in determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening monetary policy. Again, same things, lags with monetary policy affects the economic activity and inflation and economic financial developments. In addition, the committee will continue reducing its holdings of treasury securities and agency debt and mortgage-backed securities as well. The path that they're following is going to be the same of, $35 billion of MBS and $60 billion of treasuries. And the conduct standing overnight reserve repurchase agreement operations at an offering rate of 5.3%. With a per counterparty limit of $160 billion per day. So that's where we are. No changes whatsoever to the statement. I think it sounds almost identical to what we have already learned from the previous meeting. And the markets right now, somewhat volatile, right? The Nasdaq did push higher, then sold right back down, more or less. I would say no change. Same thing for the S&P as well. And volatility is still down 3.3%. However, we did see a bit of a spike in the VIX getting back up to over 17.5. It was down to 17.25 and it pushed right back up for the volatility. So now less than 30 minutes for the Fed meeting for Jerome Powell to come on and address the market and investors and everybody else. So that's where we are. And again, do participate in the poll. Do you participate in the poll of what color will his tie be? I think it's going to be closer to blue. I think blue, or last time, what was it? Purple, right? Purple shade or something. Yeah, definitely do participate in the poll. But bottom line is the statement is out. We are not seeing a change in interest rates. They're staying steady at 5.25% and 5.5%. And the treasury holdings are going to continue to roll over. So if you take a look at, Fed's balance sheet. So that's going to be this. Total assets. So this right here is total assets on the Federal Reserve's balance sheet. It's been lowering. It's been getting down. Month over month, it's been coming down as the Federal Reserve is, reducing the holdings of their mortgage-backed securities and treasury holdings at almost 95, close to $100 billion per month. And we tapped out at close to $9 trillion. And since then, we've been coming down. This right here was the banking crisis, right? So they extended some liquidity to a lot of the banks during that time. Silicon Valley Bank and, First Citizens, like all these different banks kind of failing. And then since, they have just been on a consistent downtrend as well. We're now sitting at just under $8 trillion. Now, this right here is going to be the overall balance sheet from the Fed. So let's just go to current release. And again, you can see that right now it's just under 7.9 trillion as of October 25th. And of that, we are looking at U.S. Treasury securities, which are the U.S. government bonds. And this is the interesting part, is because during the pandemic, during a lot of liquidity that was pumped into the economy by the Federal Reserve, they were basically buying a lot of government debt, right? So the Federal Reserve was buying government debt from the Treasury Department, and that was what was keeping the interest rates artificially low. And the reason for that is because if they keep interest rates low, it's going to support the economy. It's as a form of liquidity in the market, so that businesses, investors, individuals can borrow at cheaper rates. And that's exactly what happened, which is why we're in this situation where inflation's higher. So now we're sitting at just under $5 trillion as of the week in October 25th as part of their balance sheet. And then 2.4 trillion over here is going to be mortgage-backed securities. This right here is going to be the timeline as to when everything is maturing. So you've got U.S. Treasury securities, 84 billion expires, matures within 15 days. 16 to 90 days, we've got 237 billion. 91 days, so 3 months to 1 year, 584 billion. But mortgage-backed securities is actually the interesting piece, because most of the MBS rolls over after 10 years. So in over 10-year maturities, right? Because mortgage-backed securities are longer dated anyway. So basically what they are, they're just mortgages kind of pooled in together, sold as a single packaged security, and most of them do mature in over 10 years or more, so 10, 15, 30-year fixed loans, 2.4 trillion, majority of it. So right now, they're only rolling over, treasuries. You can see negative 2.5 billion, negative 149 billion, or negative 2.5, this is in millions of dollars, so 2.5 billion, 149 million. So they're only really rolling over a lot of treasuries. Mortgages are also rolled over, negative $15.8 billion. So this could mean, again, this is speculation on my part, that they may be actively selling some MBS as well, which has obviously pushed interest rates higher on mortgages. But overall, total assets have been rolling over for the Fed. So that's where we are. So just joined watching at 2x speed to catch up. So again, thank you so much for joining, everyone. I really appreciate it. Drop a like if you're just tuning in. We're trying to get to at least 500 likes on this live stream. I would really appreciate it. Market's reaction right now is very, very flat, and that's normal because the statement that we just got from the Fed, there's no changes. The rates are staying steady at where they are. Volatility is, again, just a little bit down, close to 4% on the day, with S&P just up about 0.5%, QQQ is up over 80 basis points. But Jay Powell's speech is what's really going to be important, and that's what's going to matter from a policy, future policy standpoint, because everyone's really waiting to hear what the Federal Reserve is going to do. Not what the Fed did, but what the Fed is going to do is what matters. Just like every earnings, right? Think of this as the earnings for the market, because this is what's a market moving event, right? Every single month. So Srinivas, it's a tough question because, again, it depends on your conviction level and your percentage allocation. So it's kind of hard for me to just, look at Enphase and PayPal and their cost basis and kind of tell you, okay, it's a buying opportunity or not. But it really depends on, okay, what percentage of allocation you're already at, what's your target allocation, and what's your conviction level in these companies. For me personally, I can talk about myself that I believe that Enphase and PayPal, business-wise, as companies, they're very, very strong companies still. Fundamentals are good, but the market disagrees right now. So as I said in my previous sort of analysis and earlier in the live stream, that now it's a question about whether the market's correct and I'm wrong in my understanding of the value of these companies, or in other words, there's a dislocation, or these are value traps at the moment, right? Or in other words, there's a dislocation. So one of those two things. It's either a dislocation at these prices and the value is much higher, or it's a value trap and I am not accurate in my analysis. But that's really where we are with a couple of these stocks. And as I said in my previous video as well, look, investing, you're not going to be right 100% of the times, right? Most of the times, in fact, it's a possibility that you could be wrong. And Warren Buffett and, Charlie Munger, they've talked about this very concept, is that if you take out, their top 5 best performing stocks, right, from their portfolio of 30 and 40 that they've owned over several decades, their performance is actually subpar, right? Very, very close to the averages or even below averages. So it's really just a few companies that kind of make up majority of those gains in anybody's portfolio. And there will be times when you go through these stocks and you do all the analysis, they check off all the boxes and still end up underperforming in the short term. So PayPal and Enphase, that's where I'm at with these companies. And so Christopher, where's the problem? It's fairly priced for your valuation. You should be happy about better deals. Yes, I am. And look, don't get me wrong. I'm super excited for PayPal, trading at 51, or Enphase trading at about $75, $76. And, where it's trading right now, it's definitely low. But it's times like these that kind of, help really question you and your analysis, right? We've all been there, right? Let's be honest. Like, we've all been there. We all had a stock that we've analyzed, extensively. And in the short term, it's dropped like 20%, 30%. And it's forced us to kind of rethink the analysis and reassess what the company is doing and where is it going, right? And that's the process that I think is really going to make it or break it over the long term. But no, you're right. I'm super excited about these prices. It's just that technically they're super weak right now. Technically, they are extremely weak, and it's possible that Enphase, even sells off down to, $60, as I've said, because of how weak technicals are, and sellers are just trying to exit it at whatever price possible right now. Same with PayPal. I mean, the price action is really weak, and that's the thing, right? Price action and technicals do trump fundamentals in the short term, and that's what's really controlling the price action. Anyway, so let's see. Do you have any questions about the numbers that we just got, or the economy, macroeconomics more specifically? Yes, in mode, I've already checked. So they're reporting earnings tomorrow, in mode is. But yeah, if you have any questions about macroeconomics, or economy or interest rates, inflation, happy to go over, brainstorm. Labor market, as they mentioned, is extremely tight in their statement. And the U.S. banking system is sound and resilient. This line right here should be taken off. How many people actually believe the U.S. banking system is sound and resilient? They've got over $600 billion worth of losses just sitting on their balance sheet right now. If they market them, it would be brutal. It would be a bloodbath. The amount of bonds that they have sitting on their balance sheet that were bought at when interest rates were sub 0.5%, or sub 1%. They're just like, the market value on those is just brutal. And the only reason they're able to stay sound and resilient is because there is, these are systemically important banks. I mean, JP Morgan, Bank of America, Wells Fargo, Citi, some of the biggest banks in the U.S. and probably in the world as well, there's no risk of bank runs. There's no risk of them going down because there's a significant amount of support, right? Government support to keep them afloat. And this is also a very frustrating piece of the equation as well. It will definitely open a can of worms because, when the U.S. banking crisis happened, at the end of the day, still banks are always bailed out. And that's the frustrating part, is that being a banker is like the best job because on the upside, you make all the money. On the downside, you get bailed out, right? So it's a win-win situation at all times. But yeah, so Fortinet, I like. It's one of my favorite companies in the cybersecurity space. So Milan says, what's 600 billion at this point? You're right. I mean, it's like just numbers out there on screens. The debt level I was looking at. So I did a Twitter post earlier today. I basically mentioned that, the NASDAQ has not really gone anywhere in 3 years, right? So in almost 3 years, we haven't seen the NASDAQ do anything. If you compare it to December 2020 levels, we are practically at the same price, right? So we're basically flat since December 2020. So in 3 years, the NASDAQ has not gone anywhere. And in 2020, there was a lot of, reports and analysis of a lost decade where the next 10 years from 2020 to 2030, the markets aren't going to be able to perform and give us any returns. And 3 years in, it somewhat seems to be pretty accurate. We've still got 7 years left. But in that time period, in the 3 years that this has happened, the Federal Reserve has raised interest rates by over 500 basis points. Crude oil prices have rallied over 83%. The dollar index is up 20%. Yields are up 500%, almost 5%. And the most important of them of all, the debt. The level of debt has increased 4.6 trillion in that time period, in those 3 years, to now sit at over $32.3 trillion. So a lot of those things that I just mentioned some of them are happening for the first time in a long time. For example, yields, and of course the federal funds rate. We haven't seen over 5% since 2007. And crude oil prices obviously have been on a significant rally. That's what caused the overall inflation spike. And it's making it harder. It's making it very challenging for the market to find any solid ground and push higher. Because, again, we pushed up, we sold off, we pushed up, and we're basically flat, right, in that time period. Recently asked you on Discord about a video on Fortinet tomorrow, the day post earnings. Will you have time to do it? Yes, definitely we'll do a video on that company as well, for sure. Seems like we got one sort of a taste for some companies. I also do share my watch list with all the members in the Discord, so you can access all the watch list over there as well. Combine a chart for Magnificent. How's that looking? So yes, Kanal, that's a good point. Let's just bring that up very quickly. So this is where we are for the combined analysis for all Magnificent 7 stocks. Now this, if you compare it to where we were, we are back to October 21 levels. So in 2 years, this index has not really performed. And majority of the time, it actually spent below where it is right now. So majority of the time was spent underneath this right here, this range. So again, very, very significant underperformance from Magnificent 7 stocks as well. I mean, some of them have actually done well. I mean, for example, Apple hit a new all-time high. Microsoft hit a new all-time high. Google, not yet. Tesla, nowhere near close. Nvidia hit a new all-time high. AMD, not yet. Meta, nowhere near its all-time highs yet. Netflix, not there yet. So, and I also do consider like Apple, Microsoft to be kind of like hideout stocks, right? Because they've got the best and the most pristine balance sheets. And they've got a lot of cash, right? So they can't really go out of business, and they can invest all that cash at given current rates. And as a result, they've got a tremendous amount of income coming in every single year, $6-7 billion just strictly off of interest income, which is pretty substantial. So yeah, that's where we are. And this is a potential bull flag for these Magnificent 7, 8 stocks, which may or may not break out of the upside. So we'll have to wait and find out. But the bottom line is that, the things that I mentioned, 4 or 5 things that have pushed higher since December 2020 are making it more and more difficult for the markets to find any type of solid ground and rally. Okay. Yeah, Jito says, if there will be a lost decade, shouldn't dividend stocks be the best stocks to hold? Well, yes and no. Depends on which dividend stocks. Because, look, if you can get yields at over 5.5, close to 6%, that's considered to be risk-free. By the way, nothing really is risk-free in the market, especially right now, considering the debt levels are so high and they're only going in one direction. So 4.5, close to 5% yield, that's where I'm also comfortable in, right? I've got 25, close to 30% in cash, just sitting in a money market fund, 4.5, close to 5% cash, until the markets do see some more reasonable levels. We're talking sub 4,000 on the S&P. I'm not really super excited to be deploying aggressive amounts of cash. And then you got to tie that analysis in with volatility too, right? So that's why we've got this analysis, which basically tells us, okay, the current read on the VIX, what percentile we're in, whether we're in a normal situation, normal environment, or a rare environment, and the correlation with the NASDAQ and what percentile we are in over here. So, we'll tell you in a lot more detailed manner when the VIX is above certain levels, how many days it stays up there, what's the average drawdown period, and what's the appropriate level to be. How it's basically turning on a dial of being more and more aggressive over time, right? So right now I'm not super crazy about it, but if it ends up below 4,000, volatility spikes to over 25, 30 or higher is a big threshold for me. I will be looking to be very aggressive in the markets. Kevin says all these companies should be using their cash to do buybacks. Yeah. I mean, look, at the end of the day, in one way or another, it is going to create shareholder value. Okay? Apple is doing a significant amount of cash buybacks. It's just about which company is going to be the smartest in deploying that cash, right? These companies have multiple options. Number one, they can issue dividends, right? So that's direct cash payments to shareholders, right? So for example, Apple, by the way, Apple's dividend has not increased as how should I say, like Apple used to increase dividends consistently in the past, every single year. But in the last few years, they have really gone down in the percentage of increase. I think they've only done it by 3 to 4% over the last, I want to say like 4 years or 5 years. So their rate of increase on their dividends have really gone down. Instead, they've deployed that capital on share buybacks, which again, it appreciates the price, right? So in one way or another, it comes back to shareholders. You can either do dividends, you can either do buybacks, or you can either deploy that cash by doing mergers and acquisitions, and you can start looking at strategic acquisitions that will create better partnerships and better shareholder value. So, or you can invest in treasuries, which also generates returns, right? Income, which increases profitability, increases earnings per share. So it really comes down to their capital deployment, right? And finding the most efficient and the most opportunistic way of using that capital. Companies are no different than you and I, like investors, right? They also have a problem on their hands. I mean, yes, we don't have a $120 billion problem where we are figuring out, okay, where to invest or allocate $120 billion, but it's no different, right? They're also making the same decisions as us, but just at a completely different scale. So yeah, I mean, buybacks, dividends, M&As, either way, it's going to come back to shareholders in some way or another. Yes, so there's $1.5 trillion of commercial loans getting refinanced in the next 2 years. I think that's going to be a bit of a problem, and these are just, things or issues that we are going to come to later on, especially with respect to the level of debt, the floating rate debt, the commercial loans. A lot of those things are going to eventually come due, right? So, but percentage of investors currently in the green with PayPal, let's take past 5 to 6 years. So I don't know if it's going to show me last 5 to 6 years, but I can look at very quickly what that number looks like. I doubt it's going to be like anything over 5%. I think majority of shareholders on PayPal, unfortunately, are going to be in the red. So let's just look at that very quickly. Yeah, so we have 5.7%. So I wasn't that far off. 5.74%. So under 6% of shareholders in PayPal right now are underwater with an average cost basis of $62.48 at the moment. So yeah, the chart looks pretty brutal. It's all red. So that's where we are. By the way, we've got 8 minutes until the Fed meeting. Definitely do participate in the poll so that we can get a good data set. And also do drop a like. We're trying to get to at least 400 likes before the Fed meeting begins. Mellow assessment of American Airlines. I'll do a separate video on airline stocks. Airline stocks have obviously been selling off quite significantly, so I think I'll do a more specific video on those companies. Southwest, American, United. We'll take a look at those companies. CAD hedged version of actual US stocks. What's your choice? I think there is an S&P 500, which is hedged on the Canadian Stock Exchange. ULV. Nope, not that one. I think it's... Forgot what the ticker symbol was. There was a ticker symbol specifically which was designed for Canadian investors, hedged again. I think it was VSP. Yeah, VSP. There we go. Vanguard Investment Canada in S&P 500 CAD hedged. So this is one that one can consider. And we were having that discussion, in our Discord as well. Now, a lot of these foreign exchange decisions also come down to where your spending is going to be, right? So if you plan to spend money in a particular country in the future, then it's prudent to be holding on to that currency, unless of course it is, there's because US dollar has obviously appreciated against a lot of different currencies, so that also need to be accounted for, because sometimes even if you are, let's say, investing in your foreign currency, you could have like 20%, 30% gain, but then if dollar appreciates against that currency, and if you bring that back into dollars, then that return can diminish, right? So I have a couple videos on this topic, which explains this in a little bit more detail. But, really at the end of the day, it comes down to, okay, where are you basically spending or hoping to spend your money in what currency in the future? Okay, so Fed meeting in now 6 minutes. Drop a like. We're trying to get to 400 likes before the meeting starts, and 659 votes. We want to get at least up to 1,000. See if we can get 1,000 votes for everyone, and we are going to be ready. Do me a favor, share this live stream with other folks. If anybody wants to join, friends, family members, significant others, everybody should be listening to what the Federal Reserve and Jerome Powell is going to say. I think it's incredibly important because directly, indirectly, it affects every single person in the world. Yeah, I'll go as far as saying in the world, because 25% of the global GDP is powered by the U.S., and the U.S., the most liquid and the most traded market in the world, and the biggest market, really, New York Stock Exchange. So monetary policy in the U.S., very, very important. All right, 5 more minutes. We are expected, 43% of people expecting Jerome Powell to be hawkish today, and 39% neutral, and 19% dovish. Okay, I think that's a fair assessment to make, because I'm also in the same camp where I think it's going to be somewhat neutral to somewhat hawkish. I really hope the Q&A is better. Q&A from the press. Sometimes the questions do get way out of context, and we move on to a whole different tangent. And in the last meeting, I think it was also somebody trying to put words in Jerome Powell's mouth, which he finally cleared after when he got the chance to speak. But I'm really hoping the Q&A session's more exciting, more interesting for us. I'm going to do an audio check very soon, just to make sure that everything is working well. And again, we've got 4 minutes now. 4 minutes, folks, for the Jerome Powell speech to begin. The NASDAQ here. I'm going to switch over to the NASDAQ. So the way it's going to happen is I'm going to keep the NASDAQ over here. Then I'm going to keep the S&P 500 on the bottom right. And then we'll keep the yields, the 10-year yields over here. Okay? So all the things are going to be within the same screen. And of course, this will come off. We'll do an audio check here very soon, as soon as it begins, just to make sure that everything is working well. So you guys definitely do let me know if it's good to go. Thank you so much for answering my question. I have one more question. How a long-term investor like me can book the profits? In other words, how can he trim his position to take the profit? So again, I think it comes down to having an understanding of your target allocation versus where your actual allocation is. That's really what rebalancing is all about. There's a few ways you can go about consider selling. Number one is if the fundamentals change and the thesis is no longer valid. Number two, if the valuation has really gotten out of hand and you're getting tomorrow's price today. And number three, if you are significantly over allocated into one stock and you're looking to rebalance. So those are the main three ways you can go about it. There could be a mix of two, mix of three, or just one. But number one, obviously, if the fundamentals and the thesis changes overall, then you can consider trimming and exiting. And number two, like I said, if you're over allocated or the valuation is just way expensive, really high. Grab your popcorn and get comfortable. The show is about to start. Yes, it is. It is about to begin here. So, November 1st. Let's do this, folks. Let's do this. Couple more months left. In November, I did an analysis yesterday going over the November and December gains and the probability of success given how high the yields are. And we are still good. I mean, from a seasonality perspective, about a 60% probability that November and December is going to be green for the markets by, on average, and a median gain of just over 3%. It's not until yields get up to over 8% or higher is when things really start to be troublesome for the markets and the economy, but we're not there yet. However, there's an argument to be made that in that analysis and the study that we did, the debt levels were not as high as they are today. So one could argue that the market and the economy is more sensitive to higher interest rates today than it was, let's say, 20 years ago, because the debt levels were so much lower. So, that's maybe that's a fair argument one can make. All right, so we're going to end the poll. 700 votes. That's pretty good. Let's see if we can at least get up to 800 before Jay Powell starts talking in about a minute. And like I said, drop a like and subscribe and hit the notification bell. And also share this live stream with other folks who might be interested in listening to what Jay Powell has to say. And of course, looking at the market's reaction live. And I'll shut up here in just a couple minutes and we'll listen for the next 45 minutes. So 10-minute speech from Jay Powell, then about a 35 minute Q&A session with the press. The market's going to be taking every word that he has to say very, very seriously and trying to interpret what the future looks like for rate hikes. So we're going to do a quick audio check. I really want to see a lot of thumbs ups just to make sure that its audio is good, okay? So we're just going to do that now.
Good afternoon, everyone. Welcome. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations. In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Go to Howard.
Howard Schneider with Reuters. Thank you, Chair Powell, for doing this. To what you referenced the rise in long-term bond yields, to what degree did that supplant action by the Fed at this meeting?
Thanks for your question. So I'll talk about bond yields, but I want to take a second and just sort of set the broader context in which we're looking at that. So if you look at the situation, let's look at the economy first. Inflation has been coming down, but it's still running well above our 2% target. The labor market has been rebalancing, but it's still very tight by many measures. GDP growth has been strong, although many forecasters are forecasting, and they have been forecasting, that it will slow. As for the committee, we are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. And we're not confident yet that we have achieved such a stance. So that is the broader context into which the strong economy and all the things I said, that's the context in which we're looking at this question of rates. So obviously we're monitoring, we're attentive to the increase in longer term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. Things are fluctuating back and forth. That's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. Second thing is that the longer term rates that have moved up, they can't simply be a reflection of expected policy moves from us that we would then, that if we didn't follow through on them, then the rates would come back down. So, and I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So, in the meantime, though, perhaps the most important thing is that these higher Treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And the mind's eye goes to the 8%, near 8% mortgage rate, which could have pretty significant effect on housing. So that's how I would answer your question.
Just as a quick follow-on to be clear on this, in your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a determination, and I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't, we're not confident that we have. And that is the way we're going to be going into these future meetings, is to be, just determining the extent of any additional further policy tightening that may be appropriate to return inflation to 2% over time.
Gina.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder, if you don't
raise interest rates in December. Would the presumption be that at that point that we should expect that rates are at their peak, or is there a possibility of restarting rate increases next year? And are there any costs to taking a more extended pause?
So let me start by saying we haven't made a decision about September. You're asking a hypothetical there, but we're going into the December meeting. We'll get, as you know, 2 more inflation readings, 2 more labor market readings, some data on economic activity, and so we'll be taking, and also the broader situation, the broader financial conditions situation, and the broader world situation. We'll be looking at all those things as we make a decision in December. We haven't made that decision. I would say, though, that the idea that the idea that you would be difficult to raise again after stopping for a meeting or two is just not right. I mean, the committee will always do what it thinks is appropriate at the time. And again, we haven't made any decisions at all about December. We didn't talk about making a decision in December today. Really, it was a decision for this meeting and understanding broader things.
Nick Timmeros of the Wall Street Journal. Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a quarter point when we had the bank failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to answer it since we did publicly say in the minutes. You'll know anyway in the minutes. The staff did not put a recession back in. I mean, it would be hard to see how you would do that if you look at the activity we've seen recently, which is not really indicative of a recession in the near term. In terms of how to think about translation into rate hikes, I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. And I think any kind of an estimate that was, precise would hang out there and have a great chance of looking wrong very quickly. So I think what we can say is that financial conditions have clearly tightened, and you can see that in the rates that consumers and households and businesses are paying now. And over time, that will have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
If I could follow up, I guess what makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
Well, that's the way our policy works is, and sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see if you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we take it as it is.
Colby.
Thank you. Colby Smith with the Financial Times. In terms of the thresholds that you've laid out of what could warrant further tightening, the additional evidence of persistently above trend growth or some kind of reversal in the recent easing of labor market tightness, that seems to suggest something more powerful than just one more quarter point rate hike would be necessary. And I'm just curious if that's how the committee sees it.
So we've identified those factors. Those are not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? We'll be looking at that. Growth, we look at growth insofar as it has implications for our 2 mandate goals. We look at that. and we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment, whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay, and just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly, right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think the first, it's so important to get that first question, as close to right as you can.
Steve Leisman, CNBC. Mr. Chairman, I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy, the extent to which you may need to hike additionally. You didn't say earlier that you were sufficiently restrictive. There were forecasts for 2 rate hikes among most members of the committee. But then you just said that, we haven't made a determination. Would you say the bias right now is neutral, that there is no disposition to hike again, and that the committee largely has moved off of this forecast for 2 hikes? Or for, one additional hike?
I think you're talking about one additional.
Yeah,
I wouldn't say that at all. I would say, the language, looking at it here, in determining the extent of additional policy firming that may be appropriate to return inflation 2% over time, that's the question we're asking.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking is, should we hike more? It's not, and that is the question. And you're right that in September, we wrote down one additional rate hike, but, we'll write down another forecast, as you know, in December.
Chris.
Thank you. Chris Rugaber at Associated Press. Since the last meeting, the auto workers' strike has finished. Oil prices have leveled off. And yet, on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about those?
So there are significant issues out there. As you point out, global geopolitical tensions are certainly elevated. And that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is to monitor those things for their economic implications. So the UAW strike, as you point out, appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but I guess they've gone down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation, and we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You last month had gone to York, Pennsylvania, where you talked to last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you picked up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy, and I would say it's very impressive what the people there have put together in the face of some difficult longer run trends about offshoring of manufacturing and that kind of thing. They've done a great job as a city, I think. What you hear, and is consistent there, which is people are really suffering under high inflation. You were there. We talked to some people who, were feeling that in their businesses, and other people who were feeling it in their home lives as well. It's painful for people, particularly people who don't have a lot of extra financial resources, who are spending most of their income on the essentials of life. So we know that wasn't new, but that did come through very clearly in the conversations we had in New York. And I walked away from that even, just thinking that we really the best thing we can do for the U.S. is to restore price stability. Fully restore price stability and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result. And the same is true of growth. We've been saying that we need to see below potential growth, and growth has been strong, but yet we're still seeing this. I still believe, and my colleagues, for the most part, I think still believe that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market conditions to get to fully restore price stability. So, but it's only a good thing that we haven't seen it, and I think we know why. Since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower growth. It's supply side improvements like shortages and bottlenecks and that kind of thing going away. It's getting a significant increase in the size of the labor market now, both from labor force participation and from immigration. That's a big supply side, gain that is really helping the economy, and it's part of why GDP is so high, is because we're getting that supply. So we welcome that, but I think those things will run their course, and we're probably still going to be left. We think, and I think, we'll still be left with some ground to cover to get back to full price stability, and that's where monetary policy and what we do with demand is still going to be important.
I'm curious against that backdrop, if you've gotten any clarity on lags, if you have an economy that's been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline, and that it may have already come into effect?
I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example, an example of where you wouldn't have felt this yet is debt that had been termed out. But it's going to come due and have to get rolled over next year or the year after. So, and there are little things like that where the effects are just taking time to get into the economy. So I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to get a clear answer and say, I'm just going to assume this, is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it. So slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the dot plots out the window, that every meeting is live with the possibility of a rate increase for right now. Doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment meeting by meeting.
Well, so let's talk about the dot plot first. So the dot plot is a picture in time of what the people in the committee thinks is likely to be appropriate monetary policy in light of their own personal economic forecast. In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change. For example, I mean, many things could change that would cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there our thinking, and as we approach the meeting, we'll all be, my colleagues and I will be talking about how we're processing that data. In terms of, we're not really changing the way, in terms of growth, what I said was below potential. So what you have here recently is growth that is temporarily, potential growth is elevated for a year or two right now over its trend level. So the right way to think about it is what's potential growth this year. People think trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%. But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration, and with the better functioning in the labor market, and with the unwinding of the supply chain and shortages and those kinds of things, you're seeing actually elevated potential growth. There's catch-up growth that can happen in potential. And that means that if you could be growing at 2% this year and still be growing below the increase in the potential output of the economy. I hope that's clear. That's really what's going on. That's why I would say it as below potential.
But if you could clarify what I asked about meeting by meeting, are we essentially now supposed to assume that it's a meeting by meeting, live meeting with a chance of a rate increase that will be decided on subjective criteria rather than objective at each meeting?
I don't know that I want to just accept anybody's characterization of it. I'll tell you how we're doing this. So we're going meeting by meeting. We're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic data, including financial conditions and all of those things that we look at. And then we've come very far with this rate hiking cycle, very far. And you saw the spread at the September meeting of, it's a relatively small spread of people think 1 or 2 additional hikes. So you're close to the end of the cycle. That was an impression a belief as of September. It's not a promise or a plan of the future. And so we're going into these meetings one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Neil. Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So, committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering. And I know there are many candidate explanations for why rates have been going up. And QT is certainly on that list. It may be playing a relatively small effect, although I would say at $3.3 trillion in reserves, it's not, I think it's hard to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the Basel III endgame capital proposal. You've gotten a lot of pushback from people on different aspects of the proposal, and you yourself expressed some reservations. And I'm just curious, could you accept finalizing that proposal without significant changes?
So that proposal is out for comment, and we expect a lot of comment. We won't get those comments until the end of, well into next year. We've extended the deadline, and we'll take them seriously. We'll read them. I'll say what I do expect is that we will come to, we're a consensus-driven organization. We'll come to a package that has broad support on the board.
So does broad support mean more support than the proposal had?
It means broad support.
Janelle Marte with Bloomberg. So, in addition to persistence, when you look at long-term treasury yields, what else are you watching to evaluate how those tighter financial conditions are hitting the economy and if it will lessen the need for further tightening? Also, do you think that those higher yields could affect banking stress?
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich environment, and we tend to look at a few of them. I'm not going to give you the names, but they're a few of the common ones that people look at. And so they're looking at things like the level of the dollar, the level of equity prices, the level of rates, the credit spreads. Sometimes they're pulling in credit availability and things like that. So it isn't any one thing. We would never look at, for example, long-term treasury rates in isolation, nor will we ignore them. But we would look at them as part of a broader picture. And they do play a role, of course, in many of the major standard financial condition indexes. Your second question was banking stress. So it's something we're watching. As you know, we did have there were issues with interest rate risk and also funding uninsured deposits in the things we went through in March and thereafter. And so we've been working a lot with financial institutions to make sure that they have good funding plans and that they have a plan for how to deal with the kind of portfolio unrealized losses that they have. We do think the banking system is quite resilient. We had a handful of bank failures, but so that's what we're out there doing, and we don't have any reason to think that these rate hikes are materially changing that picture, which is one of a strong banking system and one where there's a strong focus by banks and by supervisors on liquidity, on funding, and those sorts of things.
Thanks, Mr. Chairman. Scott Horsley from NPR. Last week, you and your colleagues put forward a proposal to lower the cap on debit card swipe fees for comment. Could you just talk a little about the considerations there, what it would mean for merchants, for banks, for consumers, and also just what y'all are seeing in terms of the use of both debit and credit cards in the payment system?
So you're right. We put a proposal out for comment is what we did. And, this is a job that Congress assigned us, as you of course know, in Dodd-Frank, and all we can really do is faithfully implement the statute. That's all we're trying to do. What else can we really do? It's a 90-day comment period. We typically don't comment on these things once they're out for comment, and we do hope that stakeholders, and we know that they will use this opportunity to express their views. They haven't been shy about that. So that's critical, and that's what I can say about that now.
Thank you. Thanks, Chair. Edward Lawrence with Fox Business. So over the last 3 months, the year-over-year PCE inflation was at 3.4%, core well over 3%. You've said in the past 2% remains the Federal Reserve target, but with no rate increase today, how long would you be okay then with a 3% or 3% plus overall inflation?
You know, the progress is probably going to come in lumps and be bumpy, but we're making progress. You know, I think the core PCE came down by almost 60 basis points in the third quarter. So if you, the best thing I could point to you to would be the September SEP, where you know, the expectation was that inflation by the end of next year on a 12-month trailing basis would be well into the twos, and the year after that further into the twos. So that's if you look historically, that's sort of consistent with the way inflation comes down. It does take some time, and as you get, you know, as you get further and further from those highs, it may actually take a longer time. But the good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
Well, you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery, and so we're really committed to not letting that happen. You know, for the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks are, you know, have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Simon Rabinovich with The Economist. Quick follow-up to the question about banking stresses. You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the bank term funding program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question. We haven't really been thinking about that yet. You know, it's November 1, and that's a decision we'll be making in the first quarter of next year.
Okay. Sorry, quick separate question about inflation expectations. The Michigan Sentiment Survey showed a big jump in 1 year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time around, how big of an input will that be into your December thinking?
Yeah, we look at a range of things. I think the UM thing got blown out of proportion a little bit. It was actually a preliminary estimate that got revised away, and I said it was preliminary in that, but that didn't get picked up. So we look at many things, and so really look across the broad array of surveys and also market-based estimates, and and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find one reading that is a little bit out of whack, but honestly, the bulk of them are just very clear that the public believes that inflation will come down, and that's, of course, we believe that's critical in winning the battle.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions. I wanted to see if you could talk about the neutral rate. You mentioned today that you're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. So I was curious if you could elaborate on that at all and whether that means the neutral rate, in your view, has risen.
Yeah. So first thing to say is that it's very important. It's a very important variable in the way we think about monetary policy, but you can't identify it with any precision in real time, and we know that. So you have to just take that. You have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or, attempt to, to sort of agree as a group on whether our star has moved or not. Some people think it has. Some people haven't said that don't think it has. Ultimately, it's unknowable. And so really, again, what we're focused on is, looking at the data and giving ourselves a little more time now to look carefully at the data by being careful in our moves. Does it feel like monetary policy is restrictive enough to bring inflation down to 2% over time? That's the question we're asking ourselves. I think, years from now, economists will be revising their estimates of R star as it existed on November 1, 2023. We can't really wait for that in making policy. We have to we have to have those models and look at them and think about them, and ultimately we've got to look at the effects that policy's having, accounting for the lags, which makes it difficult.
If I could follow up on a wages point earlier, you talked about the inflation outlook, but I'm curious if you have any concerns whether wage inflation at its current level could risk pushing up overall inflation or reacceleration.
So if you look at the broad range of wages, wage increases have really come down significantly over the course of the last 18 months to a level where they're substantially closer to that level that would be consistent with 2% inflation over time, making standard assumptions about productivity over time. So it's much closer than it was. And that's true of the ECI, which is the one that we got this week. It's true of average hourly earnings and compensation per hour too. So, and all of them are kind of saying that, which is great. And you have to look at a group of them because any one of them can be idiosyncratic in any given reading. So that's what you see. And so what you saw with the ECI reading was, if you look back comes out 4 times a year. If you look back a couple of quarters, you'll see it was much higher, and then it came down substantially in June. And then the September reading was more or less at the same level as the June reading. So in a way, it's just validating that decline. And it was very close to our expectations internally too. So I think we feel good about that. Also, I would say it isn't, in my thinking, it's not the case that wages have been the principal driver of inflation so far. Although I do think it's fair to say that as we go forward, as monetary policy becomes more important relative to the supply side issues I talked about and the unwinding of the pandemic effects, it may be that the labor market becomes more important over time too.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, are you now as concerned about overshooting and raising interest rates too much as you are about getting inflation down to the 2% target?
So as I mentioned, I think for much of the last year and a half, the concern was not doing too much, not doing enough. It was not getting rates high enough in time to avoid having higher inflation expectations become entrenched. So that was the concern. I think we've reached now more than 18 months into this. You can see by the fact that we have slowed down, although we're still trying to gain confidence in what the appropriate stance is. But you can see that we think, and I think, that the risks are getting more balanced. I'll just say that they're getting more balanced. The risk of doing too much versus the risk of doing too little are getting more closer to balance, because policy is clearly restrictive at 5.25% to 5.5%. That range, if you take off a mainstream estimate of the expected inflation, take 1 year inflation, you're going to see a real policy rate that is well above mainstream estimates of a neutral policy rate. Now that's arithmetic. It doesn't really, what the proof is really in how the economy reacts. But I would say that we're in a place where those risks are getting closer to being in balance.
And you said the proof is how the economy reacts. What are you looking at to be sure you're not overshooting?
Well, I think what we're looking at is, is inflation still broadly cooling? Is it sort of validating the path we saw over the summer, where inflation was clearly cooling and coming down? Now, we've seen periods like that before, and there hasn't been follow through. The data have bounced back. So what are we seeing? Are we seeing, is inflation still coming down? So that's the first thing. Second thing is, in the labor market, what we've seen is a very positive rebalancing of supply and demand, partly through just much more supply coming online, and with labor demand still clearly remaining very strong. When you have the kind of job growth we've had over the last quarter, it's still very strong demand. So, and you see wage increases coming down, as we discussed, but coming down, in a kind of gradual way. I think we want to see that whole set of processes continue.
Brian Mena, CNN. Do you think that has been any structural change in either consumption or in the job market that's pushing up consumption? You obviously saw the third quarter GDP figures, which were strong, and some economists have expected revenge spending to have fizzled out by now. So I'm kind of wondering if there's been any structural change in consumption.
I wouldn't say there's been a structural change in consumption. I would say it's certainly been strong. And so a couple of things. We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it. There may be, we've been, like everyone else, trying to estimate the amount of savings that households have from the pandemic when they couldn't spend on services really at all, or in-person services. And, there can still be more of that than we think. Although at a certain point, we're going to be getting back to pre-pandemic levels of savings. We may not be there yet. So clearly people are still spending. The dynamic has been really strong job creation, with now wages that are higher than inflation in the aggregate anyway. And that raises real disposable income, and that raises spending, which continues to drive more hiring. And so you've had that whole dynamic has been, and also at the same time, the pandemic effects are wearing off, so that goods availability, automobile availability is better, or was better. Really not reacted very much so far to this. As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and the economic effects. And it isn't clear at this point that the conflict in the Middle East is on track to have significant economic effects. That doesn't mean it isn't incredibly important and something for people to take really important notice of. But it may or may not turn out to be something that matters for the Federal Open Market Committee as an economic body. But what the Financial Stability Report does is it calls out risks, and that's what it's doing, is calling out a risk of that. And the war in Ukraine, the same. The war in Ukraine, did have immediately very significant macroeconomic implications because of the connection to commodities. So, thank you.
Thank you.
Thanks very much.
All right, everyone. So I don't know what happened there. For 1 second, it just froze for some reason. I did lose a lot of viewers during that freeze. But nonetheless, I've got a bunch of notes here. The market's obviously rallying higher quite significantly, and the message is very clear. They don't know what the plan is. They're obviously going to be putting out an SEP, Summary of Economic Projections, in December, which is going to once again highlight what the path of future rate increases or rate cuts looks like in 2024. But the most part, he did mention that, look, the economy continues to be very, very resilient, and they're not really sure why that is. They want softening in the labor market. They want softening and below trend or below potential growth in the GDP, and they're not getting that. 4.9% growth in GDP. They did mention that consumer spending is still pretty elevated. Housing activity, Jerome Powell said that is coming down with mortgage rates being as high as they are. And big business fixed income investment is coming down. Again, payroll gains on average have been over 266,000 with 3.8% unemployment rate. And job vacancies have been softening a little bit as well. And the jobs to worker ratio, which again is the unemployed to the job openings to unemployed persons ratio, continues to come down as well, but still sitting at just about 1.5. Inflation is running above target. And they have already seen, over 525 basis points worth of hikes and over $1 trillion of holdings being rolled over from their balance sheet. And yet they continue to, again, question the resiliency of the economy with their higher interest rates and the rolling over of the balance sheet as well. Now, one thing that obviously caught the markets off guard was the idea, which Jerome Powell said, that we are not at sufficiently restrictive levels yet. I think that's really what the media is going to pick up on. Most headlines will most likely be that we're not at that sufficiently restrictive level, according to Jerome Powell and the Fed. And when is going to be that level, God knows. And they mentioned that, look, as long as I think inflation stays above trend of over 2%, I think they're not going to call it quits on interest rate hikes or cutting rates, right? Because he also did mention that, cutting interest rates is not even a question right now. I mean, right now they're focused on whether they're going to raise more or not. So cutting interest rates is not even a question. So he did mention that the not restrictive levels are right now we're not there yet, and financial conditions to be persistently tight is the most important thing. That higher treasury yields are increasing the higher borrowing cost, and 2024 committee will do what's appropriate. We have not yet made a decision on what's going to happen. And now when it comes to recession, they don't know how persistent rates will be at these with high levels, so they don't really know what that lagging effect is going to be on the economy. So housing market slowing down, again, continues to be very resilient, policy restrictive until we believe inflation is on its way lower. So again, the only way they're going to take their foot off the gas is when they actually believe that inflation is on its path lower and closer to the Fed's target or even below that. Now, this is also very interesting, is that they believe that it is likely to be true, and this is actually quite interesting. This is about as clear and direct the Federal Reserve can be, that it is going to be important for inflation to come down. It is most likely going to be true that there needs to be softening in the labor market and below trend growth in the economy. So they said that, in other words, there is a very low likelihood of a soft landing scenario where inflation comes down on the back of a very stronger economy. In other words, the most likely outcome is going to be that they need to see a softening in the labor market and the economy running below trend growth here is needed to see inflation come back down. So this is about as direct as Jerome Powell and the Fed can get with respect to managing expectations on monetary policy. And they've made progress. They mentioned PCE, core PCE has dropped 60 basis points in the third quarter, so it takes time and it may take longer. And they mentioned that wages are not the factor that's driving inflation, and they are now pretty balanced on the risk of doing too much versus doing too little. So that's where we are with the Federal Reserve meeting. The market's obviously pushing higher. Nasdaq's up 1.5%. S&P's up 1%. So we did see a little bit of a pullback, and the yields are down 3.3%. So definitely dropping a little bit on the 10-year treasuries here on the day. And a lot of individual tech stocks obviously having a very strong day, with AMD up over 9%, Nvidia up over 3%, Microsoft's up 2.5%, Amazon's up over 2.8%, Meta's up over 3%, Tesla also rallying up over 1.5% as well. So that's going to be it for today, folks. Thank you so much for joining for this longer live stream. All I'm asking in return is that you drop a like, subscribe to the channel. I would really appreciate it. And of course, link to our Discord and Patreon is going to be down below. You will not regret it. There's a lot of valuable information, insights, intrinsic values, and of course, volatility spreadsheets, members-only private videos. There's a lot of stuff that we are going to include as part of the analysis and for you to access on a daily basis, because this is really a very, very important type of analysis. And this may not be useful for majority of the times, but when it is useful, you better would want to have access to this to basically understand, okay, where are we on a percentile basis so that we can take advantage of those buying windows and buying opportunities. So that's where we are right now. Hope you guys enjoyed this video. Like I said, as always, make sure that you drop a like. I would really appreciate it. Subscribe to the channel. Hope you all have a fantastic day. I will be doing the market update later today, and hope you all have a great day. So see you all in a little bit. We'll be doing the market update video shortly. So thanks again. Happy investing.